All right. Good morning, ladies and gentlemen. Welcome to MACROACE with your host, Tony, also the head financial analyst at FinancialJuice. Thank you very much for joining me. Don't forget to share this video with your fellow traders and friends. If they haven't watched me or watched our videos yet, then do go on ahead and share that link. But for now, let's go into Nonfarm Payrolls and what to expect. We have the deviations to go through, the sentiment as well surrounding non-farm and also the US economy, what's currently been going on with the Japanese yen, and how that's had an overall impact on the markets as well. So first, what is non-farm payrolls? So it is the net amount of jobs created within the prior month. So after the first week of literally within the first week of the month, do we get data from the prior month jobs, how many have been added. There's also two ways that this survey is made up of. So you have the household survey asking the consumers or the employees whether they're on full-time or part-time, or if they're working or not. And then you have the establishment survey, which asks the businesses how many people they have on their payrolls. And from that figure, the establishment survey is derived the non-farm payrolls figure, or the headline figure itself. The household survey report provides the unemployment rate. So just to let everyone know, that's what that means there. Okay. Now, how does it affect the markets? So with the currency, usually when you get a stronger than expected reading for non-farm payrolls, that favors the currency, or in this case, the dollar, because that shows that there's confidence or there is strength within the US economy. And that in turn causes the dollar to rise further in anticipation and in expectation that the dollar will continue, or the US economy will continue to strengthen, and provides more confidence to those currency traders. Then for the stock market, now within a normal market environment where the central bank isn't tightening interest rates or isn't doing anything crazy or whack with their monetary policy, then what happens is within the stock market, you see an appreciation when employment data is better than expected. However, within this tightening market environment, we're still not out of it yet. Rather, woods within the Federal Reserve and their tightening cycle, higher than expected non-farm payrolls figures can lead to the stock market taking a hit. And we've seen that with the ADP employment change data we had yesterday as well. When it came in stronger than expected, it was about an 85k deviation from my memory. From what we had seen, the forecast was 150k, came out 235k. So that's how the stock market will generally react, or can have a similar reaction today as we'd seen yesterday. So the bond market, a little bit more different now, with still within the tightening phase. Whenever you do get a stronger than expected figure, then you'd also expect the yields on those bonds to also move towards the upside in anticipation of a higher rate of interest from the central bank or more monetary policy tightening as well. So that's something else to look out for too. But of course, if we do get a worse than expected picture or report overall, or big drop in the headline figure, that can lead to bond yields going down and bond prices going up instead, which in this case, it means that the expectation for rate hikes actually becomes smaller rather than higher. Okay. That's what a lot of bond traders do. When they start to see that the economy is heating up, or the central bank is looking to, or is going to tighten monetary policy because the economy is becoming stronger, or was stronger than expected in a certain area, then they'll look for a higher yield of return instead, and in favor, and that will lead to higher yields and lower bond prices. So that's how the market would generally react to the non-farm payrolls release. Now, what are the indicators weighing on sentiment at the moment? So you have inflation at 7.1% compared to the prior 7.7%. PC price index at 5.5% for the year on year versus 6.3%. GDP third quarter final data was at 3.2% versus minus 0.6% for the second quarter data final. The unemployment rate unchanged at 3.7%. The ISM Manufacturing Employment Index data that we had this week showed that employment in that area, in the manufacturing sector, ticked up back above the 50 level, which is seen as a good sign that that area is expanding or doing well, to 51.4 compared to the prior 48.4. The JOLTS job openings data, which also moved the markets as well this week, came in at 10.458 million compared to the prior of 10.334 million. And that, of course, with that better than expected or higher than expected JOLTS data, that led to some dollar strengthening as well. So when we're talking about these employment figures and inflationary figures too, they're still going to have that impact whereby if they do come in hotter than expected, that could lead to a change in the Federal Reserve's path for their monetary policy, maybe extending raising rates for longer or getting to their terminal rate that they would want to get to much sooner than previously anticipated. So that's what happens within the short term. These economic indicators have that effect and build up that sentiment, okay, that provides what the markets could be expecting from the Federal Reserve in the future, of course, at the next meeting at the beginning of February. Now, employment costs, we'd seen it was at 1.2% versus prior 1.3%. And then as I said, ADP at 235k versus a prior 127k. Reminder, as I said, the forecast was 150k, so completely smashing that data or that forecast yesterday. Now, what are the triggers for the economic release? What kind of figures or level are we looking at to see some form of a market reaction or strong market reaction? So this is according to economists and what they see. Okay, so non-farm payrolls, they see a high estimate of 350k, so that would be a total deviation or a deviation of around 150k of the median forecast that we have, which is 202k. And then on the low end, they have a forecast of 130k, so with a total deviation of 70k. Then economists also see a high estimate of 3.8% with a low of 3.5%. Average hourly earnings, again, key inflationary figure too, to understand, is there a wage price spiral? Is it going to get out of control? Is it going to stay strong, or is it going to decline and weaken? That has a high estimate of 5.2% with a low estimate of 4.8%. So that's what we want to be aware of, okay? That there is, if we're looking at just the high estimate or the middle range then of the non-farm payrolls figure, you can see there's about looking around the 100k deviation range for the non-farm payrolls figure itself. And then you have the other bits of data to, of course, private payrolls, looking for a high estimate of 240k, according to economists, and then 110k on the low end. So investment bank views, okay? Well, now what do they see? So Goldman Sachs forecasts non-farm payrolls to come in at 225k, with the unemployment rate remaining unchanged. That's and then JP Morgan seeing 280k, with the unemployment rate to decline to 3.6%. Bank of America see non-farm payrolls at 215k, with the unemployment rate expected to also tick down 3.6%. And then Morgan Stanley looking for non-farm at 885k. One of the investment banks that are looking at a smaller than expected figure compared to the median forecast that we have today. Hey, Scotch and Stock says, Happy New Year. Happy New Year to you too. Happy New Year. Good to see you again. And then they also expect the unemployment rate to remain unchanged as well. Now, the previous report. So the number of persons not in the labor force who currently want a job was little changed at 5.6 million in November and remains above its February 2020 level of 5 million. So what do you take from that? That the jobs report last time around was solid. It was quite strong. But the other thing to understand is that it was smaller it was a smaller gain compared to what we've seen in the past within 2021. So monthly job growth has averaged 392,000 so far in 2022, compared with 560,000 per month in 2021. All right, so job creation, or the amount of jobs being added, is significantly smaller, but a lot of that's we're still getting strong figures overall, around the 390 to 400k range as an average for 2022. What we've seen, we'll see what 2023 brings us. Of course, we're getting a December report, so we'll have to wait next month to see how good or bad January is. Path says, appreciate the brief outlook, saves time on so much. Good. I'm glad you're finding it useful. Don't forget, share the video, get the word out there that if you are finding this useful and you are tuning in, then don't forget to share the love, share the video, subscribe to the channel, like it as well. Thank you very much. Right, so let's carry on. So the Fed and government views. So on 4th of Jan, we had Fed's Kashkari saying that once the Fed allows for policy lag effects, we can then assess if rates need to go higher or remain at the peak for longer. So again, the employment figures, the inflation figures, of course, we're going to be getting next week, so don't forget to tune in for that for the US. Those two key metrics for how well the US economy is doing and what the focus is for the Federal Reserve at this time within the tightening cycle are going to be very important. And that's where they want to see, first of all, inflation falling off and a good decline in that. But they also want to see, to a point, unemployment rising and less jobs being added to make sure that the economy doesn't overheat as well. So that's what Fed's Kashkari is talking about there, that you'd want to wait for the Fed's policy to take effect, basically in a way that's enough for them to say, hey, let's kind of take a step back and maybe take a different approach later on. At December 16th, you had Fed's Mester saying, although growth is slowing, there is no negative activity that is predicted. Although a lot of what we've seen in the past, and also the past week as well, that there's been talk that a lot of businesses, or 50% of businesses, I think, we'll go through it. I did put that into the prep. Are looking or are expecting a recession this year, but there's also some positives to that. It's not just all negative with that figure. But Fed's Mester just saying that although growth is slowing, although things are going to slow down a bit, it's not going to be as bad or as negative as some people may predict or could or are trying to predict. Powell said that he sees little progress in lowering average hourly earnings. Again, a key figure. So again, if it is average hourly earnings is going to be sticky, maybe that's something to expect from the report, that you might not get too much of a market reaction if the average hourly earnings ticks up a little bit or drops by a little bit or kind of stays stagnant. If we do get a bigger than expected figure with the average hourly earnings, that could help rock the boat for the rest of the report as well. Lo-fi Lely? Oh, apologies if I said it wrong. It says, Tony, you're my idol. The pit trader says, let's go, Tony. The markets are going to be robbed today by you. Hey. Yeah, okay, let's see. William Riker says, Tony in the hizzle for the nizzle, fizzle, pizzle. All right, so let's carry on. So December 8th, Sir Yellen said that I believe the US can avoid a recession because there is no wage price spiral and supply chain bottlenecks are beginning to ease. So again, focusing on the wage price spiral there, that being a key point of contention, whether that's going to continue driving inflation, how much that's going to drive inflation, how quickly that will take effect within the economy. Fed's minutes. No one predicted that rate cuts would be necessary in 2023. Again, for the non-farm payrolls figures, if they're expecting the employment data kind of slowly or see a bit of a slowdown maybe in activity overall with businesses and the rest of the economy as well, then it's more or less letting the economy take a bit more time to cool down. They're not there yet, is what is what to kind of take from the Fed minutes that we had seen on Wednesday. Not enough, of course, of a slowdown for the Fed to consider cutting rates in 2023. So, investment bank views and sentiment. Now, this is very important for the markets and the sentiment overall of what's kind of going on. The Bank of Japan yield curve and bond buying led to a stronger yen. So you had the Bank of Japan that had not on December 20th actually decided to expand their yield curve control from spot 2.5% to spot 5%. That's a key move, right? It's a key. That's basically saying that the Bank of Japan is going to allow bond yields to move slightly higher. And when bond yields start to move higher, that means that there is anticipation that the central bank might start to be in the process or look to start to go into the process of tightening monetary policy or being less loose compared to what they were in the past. So that sent the yen flying in the markets for quite a while, only until today when we were looking at the currency strength chart that you had the currency strength chart that you had the yen seeing some weakness again with the unscheduled bond buying from the Bank of Japan. So the Bank of Japan was trying to fight back against traders betting that it will further relax its yield curve control policy. You have that going on. December 29th, you had, according to Credit Agricole CIB's global market division in Tokyo, they said that we are aware that the Bank of Japan may adjust the yield curve control in January, according to Yuji Saito. And he stated the Bank of Japan may boost the yield ceiling to 0.75% or shift the target tenor to a 5-year note. So, i.e. just moving to maybe moving to parking more money into a different note instead, so as to not kind of rattle the market or the bond market too much in Japan, to kind of keep it level. On January 6th, you had Japanese bonds that rose when the Bank of Japan announced another unplanned bond purchase, and the yen fell further after reports suggested that the Bank of Japan policymakers see no need to make more substantial yield adjustments. So the currencies and how they've been reacting to the Bank of Japan's policy and what they've been doing has been very significant and could still play a role in how we see the markets react today and where we might see the biggest reaction or more sensitivity, should I say, within the currency market. And then January 5th, you had JP Morgan survey saying the majority of firms anticipate a recession in 2023. Now, if we look at the prior, that was one thing to add. So from the JP Morgan survey, but businesses were still looking to hire and not looking to change their hiring policies or strategies for the year to come, although they expect a recession. So it paints a mixed picture. Yeah, we're expecting a slowdown within the economy, a recession, but we're still okay, and we've got enough manpower to kind of keep hiring when we need to. All right, so this is the previous release. Okay. Yeah, that's one thing to just before I kind of carry on. So DryZ said, have they said where they see the neutral rate and when are the dot plots coming? So the dot plots would always come with the summary of economic projections. Now they won't say where specifically they see the neutral rate. Of course, that changes, and that has been changing. Around the 5% mark is what's kind of been floated around, or 5.5% to 5.5%. But that's not clear cut. That's not confirmed. So that's one thing to be aware, that it could change and it could go higher depending on how data plays out. Right. William Riker says, do you think we're still in good news is bad news situation, or recession is starting to be more of an issue than interest rates? So you've got different factors of sentiment and economic data that traders are focusing on. You have, so the prime example was yesterday with ADP. The good news was still bad news for the stock market. Okay, The dollar had seen an appreciation and the S&P 500 had seen a depreciation off of the back of that data too. The JOLTS data, as mentioned earlier on, came in hotter than expected, and that caused, again, a similar reaction where the dollar had seen an appreciation and stocks and the S&P 500 or stock indexes had seen a depreciation. So we're still in that environment yet. The recession will be, a lot of people would or could try and price in the expectation of a recession already happening, is what a lot of traders are feeling and saying in the markets. Although figures, what we see if we're looking at economic indicators, it doesn't say that there is a recession happening yet. Okay, there is still, some will say that some of the indicators are that there are a lag between indicators and what's actually going on within an economy to say, yeah, okay, you may be feeling a recession now, but the economic indicators don't point to a recession yet or that soon. So there's that mixed fact. There's those mixed points of view kind of confusing the market. So that's why the economic indicators provide a more of a clearer direction as to what direction the Federal Reserve may go into. So going with these releases data point by data point. So whether or not the US is in a recession, that could mean that economic releases may lose some of their importance if everyone's focused on whether the US economy is going to recover. But we're yet to kind of see that. The markets are still reacting to these economic data points as well. Hopefully that answered your question. Mohammed said, guys, I'm new how to trade employment change. William Riker said, very carefully. Yeah, you're not wrong there, buddy. Very carefully indeed. I guess, are you on a practice account? If you're practicing, if it might be a good idea to go with a practicing account. I'm not saying you should do whatever you want to do, but if it's the first time you're trading employment change, probably best to keep your money safe. But that's just being cautious, unless that's your kind of style. And you go, what, bang, here we go, let's go. All right. Path says, I'm a new subscriber. Are you going to have these summary videos every day or on the key events days? Only on the key event days. So I did nothing throughout the week until I had non-farm. Next week we have the inflation data, was US CPI on Thursday. So next week is probably then on Thursdays when you're going to see me again. Prashant James says, Tony, my man, trading, listening to you. Hell yeah, baby. All right. Hopefully I answered some of your questions in the chat. We've got plenty of time, so that's why I'm interacting with you guys more. Apologies if I haven't in the past. But let's go look at the previous release and what the market reaction was with that. Well, now, also to bear in mind, we're looking at how the Canadian data had an impact on the Canadian dollar. But for now, we'll focus on the US release and how that previous data had reacted. So about 5 seconds before that release there, we'll see what the data was like and how that reacted, or what the market reaction was like. So here we are. So you'd seen much better than expected figure from non-farm. It came in, there was a 63k deviation. Okay, you had the average earnings year on year also higher than expected at 5.1%. Private payrolls was also higher than expected. Average earnings was also higher than expected as well. The unemployment rate remained unchanged. So this is the previous market reaction. So the economist looking at a deviation of around 100k for a strong market reaction, or 150k on the high end, and then 70k on the low end. If you're looking at the mid-range, let's say between 100k for a strong market reaction, that could be one possible scenario. But this is what we've seen here, that with a 63k deviation, blasted the figure out of the water, with the rest of the report as well being overall stronger. That had led to this market reaction on the S&P 500. Okay, so we've kind of skipped forward. You can also see on the Canadian dollar as well, that had also seen a movement towards the upside. If I can kind of go back a little bit. Might need to go back a tiny tad bit. Yeah, so the Canadian unemployment rate had also ticked down as well to 5.1%, so the 0.2 deviation on the forecast. That on top of the figure coming in, although it wasn't that high, there's only a 0.1k deviation. It's also the fact that if you are looking at the US dollar denominated currencies, if a dollar denominated currency does well, those are the dollar denominated currencies will also do well. That's what we've seen in the past as well. Hence, even though with a small deviation for the Canadian employment change, it's still seen strengthening from the Canadian dollar. Of course, now if the data was much weaker than expected, that could be a different picture. But if you have a strong enough dollar to kind of power the momentum for the other dollar denominated currencies, that could be it might be a different picture where the Canadian dollar could see a bit of strengthening instead. That's one scenario or a couple of scenarios that could occur within the market from the data. But the key point being here, the dollar had strengthened, and you had seen the S&P 500 take a hit from that data there. So if I kind of go forward a little bit. So you can also see gold. That's how gold reacted. Of course, if the dollar is up, gold goes down, right? They're the two polar opposites, okay? Just to, if somebody was in my head, if somebody's asking that question in the chat, I haven't looked at the chat back at the chat yet, but if I think that's your question, then just remember that if the dollar goes higher, gold goes down. Right, kind of move forward. So the Canadian CAD JPY seen about 40 ticks there. We're looking at GBP CAD as well. So again, a Canadian dollar seeing strengthening too. And then there's the bond, a 2-year bond. It's had seen a decent move down of 80 ticks. Remember, the bond yield would go higher off of the back of that bond price going lower. So that was the release. Let me exit this here. So that was a release there. Let's bring in the deviations then. Let's bring that in here. Okay, got loads to go through. All right, deviations then. Let's quickly go through this. If you don't know what deviations are, this is measuring how the different assets react in the market to the releases that we get from the government and what that does. So, and how much of a movement that causes within those asset classes. So we can see here in the last Nonfarm Payrolls report, now we've seen the biggest market reaction so far from Nonfarm Payrolls on the NASDAQ with this release here. So we had seen a 63k deviation last time round, and similarly, you can see that when there has been around a 60k to 100k deviation, you've got a decent reaction at least. But if you're looking at the low end from 60k going towards a 100k, you're kind of mid-ish within that range, then you can if you have other bits of data to back it up as well, with the payrolls, average hourly earnings, and the unemployment rate, if that stays where it is or goes down, that could also help power on the market as it had done in the previous release we'd seen last time round. So here we are. So there was 950 ticks down. So this is what the number represents. So this first figure here represents the initial market reaction going to the wick of the candle. I always like to capture the entire reaction or the initial reaction that we had seen. And then this represents, in brackets, 10 minutes after the release has occurred, going to the end of the candle. Of course, the bit that matters the most is to capture the entire move at the beginning. And then, post reaction, how much it moved then. But you can see, even after about 10 minutes of trading, comparing it to the other report that we had back here on November 4th, you'd seen there was a stronger hold on the data in the markets of 964 ticks on the NASDAQ. The S&P Also, I had seen the biggest reaction as well on the non-farm figure. You can see that last time, or back in October actually, was the last time we had reached around that 200 tick mark. And the last time we got 242 ticks down in the markets. And after about 10 minutes of trading, it was down by 234 ticks. Now, currency-wise, what is going to be the biggest moving currency? Well, historically, what we've seen is that is on the dollar yen in the past from what we've seen overall. But that doesn't mean there are other areas too. We've seen cable that in the past, look here, back on October 7th, we'd seen that was the biggest mover in the past, and also on the 4th of November too. But that's also to do with, first of all, where is the currency at the moment? What is the central bank doing? Are they being as restrictive, or are they tightening monetary policy as strongly as the Federal Reserve is? What are the political issues surrounding that nation too? So, of course, within the UK, we have the strikes, with the railway strikes at the moment. There's the energy crisis that the UK is facing, has been facing for quite a while. And there's been a chop and change or instability within the UK government, which could mean that cable could have the biggest reaction today. But on the flip side, what has the Bank of Japan been doing? They've been meddling with the yield curve control and rocking the market by saying, okay, we're going to increase the yield curve control from spot 2.5% to spot 5% to allow bond yields to go higher. But we're going to continue to buy bonds too, and we're not going to let you know. That's also causing instability in the markets too. The picture I'm painting here is that the dollar, yen, and cable have seen the biggest market moves, within the currency space in the past. All right. And yeah, out of the bonds, you've got the 2-year bond price that's continuously seen the biggest reaction compared to the 30-year. And if we're looking at let's say the less liquid or less traded currency pairs like the Aussie dollar and New Zealand dollar, even then, with a strong figure from non-farm payrolls, you do get a decent move from them as well. That's non-farm payrolls. Let me move that out of the way, as we have more to kind of go through. We've got the Canadian data to kind of go through as well, and sentiment surrounding them. Got about 8 minutes left. I'll try and go through this lickety split. Okay, that's already good. So the previous report: employment rose in finance, insurance, real estate, rental and leasing, manufacturing, as well as information, culture and recreation. At the same time, it fell in several industries, including construction, wholesale, and retail trade. Overall, painting a decent image for the employment area in Canada, but not as strong enough as what we had seen when the last figure had come out in Canada at 10.1k. Where's the economy at the moment? So inflation at 6.8% versus 6.9%. Quarter-on-quarter annualized GDP for the third quarter was 2.9% compared to the second quarter of 3.3%. GDP was unchanged at 0.1%. Employment change, as said, 10.1k versus the prior 108.3k. So there's been a lot of whipsawing with Canada's employment change data recently, and for quite a while actually in the past. The unemployment rate at 5.1% ticked down from 5.2% in the past. And the S&P manufacturing PMI was at 49.2 versus 49.6. As the highs and lows, the triggers then for the economic release. So economists are looking at high estimate of 15k with a 10k deviation, and on the low end looking at 0k or with a 5k deviation. The unemployment rate also expected with a high estimate of 5.3% with a low of 5%. And then you have sentiments such as China COVID worries that's caused the oil market to see a bit of a slump and some whipsawing that's occurred, but more of a slump because of the idea or the fear that China COVID cases and deaths could rise again, leading to shutdowns or a strong lockdown again in China, cutting off demand and also supply to those businesses that deal with China on in that space, in business spaces, particularly chip manufacturing too. You've also had Tesla cutting back as well on their vehicle prices in China today, which had led to Tesla falling pre-market because of the potential, the disruptions that have come through from the COVID worries and also the lockdowns that have affected the American business. So there's also that, the milder weather. Don't forget, Canada's economy is reliant on providing natural resources, okay, such as crude oil and also natural gas. So that's also, to a degree, to an extent, has had an effect to Canada's currency. December 12th, you had Macron saying interest rate increases have begun to have an effect, but it will take time for them to spread throughout the economy. All right, investment banks. So they see the employment change at 5K with the unemployment rate at 5.2%. Scotiabank employment change at 15K, unemployment rate at 5%, and BMO at 10K, and then 5.1% for the unemployment rate. So that summarizes the expectations then for the US and Canada. All right, let's go through the Canadian data too, because of course this is a double whammy. Now, don't be surprised if the US data takes over precedence and has sees a much bigger reaction than the Canadian dollar does. It can happen. Has happened in the past, depending on what the Canadian data has been like. But if the US data does come in much worse or much higher than expected, that could overshadow the Canadian release. But it doesn't mean the Canadian currency is still not tradable. It just means that the dollar CAD is not going to have it might not have a clear direction, depending on what happens within the figures. So the employment change data, as we've seen, there was a 0.1k deviation. It's seen dollar CAD again, the 60.3 pips towards the upside. CAD JPY, it's seen Canadian dollar strengthening off the back of a stronger dollar. Okay, about 41 pips up, and after about 10 minutes of trading, 63.2 pips up. So the CAD JPY and GBP CAD had the biggest reactions within the market at that time of the release. Could that be the same again with? Could we get a bigger reaction on the CAD JPY? Well, it depends again. You know, how much of the fear of the meddling that has come through from the Bank of Japan have an effect on the rest of the markets as well. Whew. All right. So if we are looking for, let's say, a decent reaction from the Canadian data itself, or deviation for the employment change figure, but we'd also want the other bits of data to see better data too. So with the unemployment rate, we'd want that to go down, and the average hourly earnings also tick up as well. Okay, and that is the deviations. We've got about 2 minutes, ladies and gents. 2 minutes to go. Let's get TICKSTRIKE up and running as well. So we're looking at FinancialJuice live here on our feed. If you don't know what FinancialJuice is, up-to-date news of 1, why the markets are moving, and 2, what is causing and who's saying what. And the big, or maybe there's some more information with the 6th and 7th of Jan. So it's not complete. Scroll down on here. We got a lot of data to kind of go through. Let's see how the markets lingo today. All right. If you're already peak on my 2-year bond price, looking at that. Okay, 10 seconds. Let's see what happens. Okay, 223k, 223k, higher than the forecast of 202k. The US unemployment rate 3.5%, 3.5%, lower than the forecast of 3.7%. Canadian employment change 104k, 104k, higher than the forecast of 5k. Average earnings year on year 4.6%, 4.6%, lower than the forecast 20k, 220k, higher than the forecast 183k. Average work week hours 34.4. Average earnings month on month, spot 3%, lower than the forecast of spot 8K as expected. US labor force participation 62.3% labor force participation 62.3%, higher than the forecast of 62.2%. Average hourly earnings year on year, 5.2%, 5.2%. So looking to the market reaction here, S&P 500 seeing that move towards the upside. Although looking at the dollar, did see that move towards the downside there initially. Looks to be trying to make its way back up. Now, the only key thing that we can take away from there is that you didn't get that much of a deviation on the non-farm payrolls. You got about a 20k deviation, which isn't anywhere near the deviation of looking at at least a 60 to 100k deviation. So that's one reason as to why you're probably not seeing that strong of a. You're seeing the opposite reaction from the market instead. Mohammed, I hope you're okay. If it's your first time trading, please, I hope you saved your soul. All right, CAD, let's look at the Canadian data. Canadian data saw some whipsawing. Did see a move towards the upside there off of better than expected Canadian data. Canadian employment rate, I said, lower than the forecast of 5.2%. So better data from a deviation from Canada. We had seen leaning in what we've seen compared to the dollar yen. There's a bit more choppiness there, but here dollar CAD seeing a clearer or slightly a clearer move compared to dollar yen towards the downside. Not a nice picture here actually. You don't get JPY either. That's mixed. Let's do GBP CAD. See what you did. We'll also look at gold. Do not worry. So gold, GBP CAD down. All right. So better than expected Canadian data. Canada's wiping the floor clean. The moment. Gold, let's bring you up as well. See what you're doing. Okay. Yeah, all right. That had seen spike towards the upside. But yeah, very quick to come back down. So, okay. Key takeaways then from the market reaction. One is that the data wasn't as big as economists had on their high end. Okay, remember the high estimate for the data was 350k for economists, so nowhere near that figure at all. Okay, still comes in solid though with 223k, but not strong enough. The Canadian data was also to swaps showed 36 basis points of hikes priced for February with a cycle peak of 5.05%. Okay, so swap traders trim marginally the amount of Fed hikes priced. Let's get to some measuring then. Let's see. Let's get a measure. Okay, so it's 207 ticks towards the upside. Oh, let's be a bit more precise. Okay, 200 yen. Okay, that's 72 pips, or 72.5 pips down there on the dollar yen. Let's look at CAD JPY. Okay, I was 42.9. Well, let's say 43 pips. GB CAD. And then we'll look at gold and then bond prices. Okay, 56 pips down. Gold. $123 ticks towards the upside. That initial move. Okay, bond prices. Okay, that's 38 ticks. Oops, I just... Yeah, 123 ticks was the upside in gold, and 38 ticks was the upside on 2-year bonds. All right. So as I was saying, if you're unfamiliar with FinancialJuice, that basically concludes the release there for us. Now, if you're unfamiliar with FinancialJuice, a live voice and text service giving you up-to-date data, headlines of what's being said in the market by central banks. Here you can see the Fed or how the markets are taking in the market reaction. All those bits of data kind of are compiled or curated together, okay, and provided for you. Now, this is something that a investment bank usually has or will always have access to. It's something that retail traders don't really have access to that readily. So if you're a retail trader or if you're kind of new to using a live voice and text service, then what you can do is sign up to FinancialJuice and have a play around with it. Now, first of all, so we have FinancialJuice Pro. Okay, FinancialJuice Pro, we have the live version of FinancialJuice and the Pro version. The live version has ads playing, has ad banners, has a delay to the website as a whole, but the Pro version doesn't have any of that. Okay, it's nice, clean, and crisp. As soon as the news comes through, then we deliver it to you. Okay, as soon as we can. So the Pro version of FinancialJuice is available, and it's something that you guys can have a little play with. But first, if you're comfortable with doing that, we can do is sign up for FinancialJuice for the Pro version. First, if you don't have a FinancialJuice account, make a FinancialJuice account on make a FinancialJuice account on the site. Have a username and login set, and then you will receive an email to verify your account. Verify it, go back to the FinancialJuice site. Then you can click on a button which appears here saying Go Pro. Then you can click Go Pro, pay for, if you want to, from that point, pay for FinancialJuice Pro. If you do decide to do that, come back to the website after you've received your email or your receipt. Come back to the FinancialJuice email or FinancialJuice website. Then you need to log out and then log back in again to activate FinancialJuice Pro. Okay, because otherwise it'll still say Go Pro, but all you need to do is log out and log back in with your login details. Remember, key thing is have your login details with a username and password. All right, if you don't have that, then it becomes a bit more complicated to kind of work through. All right. That's FinancialJuice Pro. TICKSTRIKE, what you're looking at here. Mohammed says, I'm good, mate. Made $25 on Dolian. Oh, nice. Very good. Very good. Good. So as I was saying as well, so TICKSTRIKE as well, we have a 7-day free trial of that. If you don't know what TICKSTRIKE is, best way to put it into words is it measures the strength of buying and selling momentum within the markets. Okay, or lets you listen to order flow. Okay, that's the key thing. Lets you listen to order flow and measure the strength of buying or selling within the markets or the different assets. So you have this is what TICKSTRIKE is. Okay, let me kind of just remove one of them away. So this is what we call a ticker, and it's got a number here, says +3, and you've got a little dial here, and you've got colors going off. So what does that mean? So a plus symbol means that there's buying momentum that is going on, and a minus symbol means that there is selling momentum. This slider here represents how sensitive you want this ticker to be. Level 1 is the most sensitive to market reactions, and it will constantly go off a lot. If the market, see there, if there's a little bit of buying or selling that occurs, TICKSTRIKE will pop off. But you can adjust that sensitivity all the way to level 15, which is the least sensitive to market reactions. So only when there's a big move that is occurring within the markets, only then will TICKSTRIKE notify you of that move there. Okay, so that's what TICKSTRIKE is, and there is a 7-day free trial of TICKSTRIKE, which I'll put in the chat here for you. Okay, have a little play with that. Don't forget to like the video, share it, subscribe to our channel as well to stay up to date with the latest videos. As I said, remember, next week is inflation. Big, important data point. Do not miss it out. Do not miss out on it. If you do, good luck to you. No, I kid. But yes, it'll be appreciative if you do join us for that session. Again, same thing, providing up-to-date sentiment and what could affect the markets. Okay, right, so that's TickStrike there. You have the 7-day free trial of TickStrike in the link in the chat. If you like trading unusual volume activity in stocks, currencies, crypto, futures, we also have unusual activity where you can join a free beta test group, okay, to which of our new service, and give us your feedback on it. Okay, that will, all the products that we've made or services that we've provided, they've all come from, the way they've improved is because you guys tell us what works and what doesn't work, what you guys want in them, what you don't want in them. Okay, that's how we've come got to the stage that we are with FinancialJuice, with unusual activity, TickStrike, and also to the Tick as well. So carry on with providing your feedback on there. Don't forget also to make sure to subscribe to the mailing list of MACROACE. Now, if you're asking me, well, Tony, where do I get the deviations? Deviations that I had shown you here. Let's bring it up again. The deviations for the economic release. Not only do we look at the, not only do I look at non-farm payrolls, but also we bring it up. Right, there we are. Not only do we look at the deviations for non-farm payrolls and how the market reacts to the figures, but also for a slew of other economic releases as well. Okay, you can see here. So we got Canadian employment. We've got the US CPI data, PPI data that we done recently. Consumer spending. We had done Canadian CPI in the past, but now that's kind of not seeing too much market reaction, so we're putting it to the side. More or less, what we need to know is that any release that has a huge market reaction or consistently large market reaction, we'll focus on that and provide you up-to-date details with that and what to kind of expect. Okay, all you got to do to get access to this is to sign up to the mailing list for MACROACE. Okay, within that mailing list, you get an email of what to expect for the week ahead, of what to expect in Asia, the US session, the European session. It's a short summary. It's not big, huge, filled with graphics or bars or bar charts or line graphs. It's short. It's a short bit of information of what to expect for the week ahead, a summary of the weekend news, and the meat of the data, or the meatiness of MACROACE, comes through with me here, speaking to you on the microphone on this YouTube live stream. But yes, so that is where we are. That is MACROACE. Thank you very much for joining me live. Scotch and Stocks, thank you as well, good sir. And yes, good luck to everyone else in the new year as well. All right. Whew. Enjoy your weekend, and I will speak to you next week. Oh yes, by the way, the email is sent every Sunday, once a week.